Global equity indices continued the positive momentum last month with MSCI World hitting new all-time high. US Fed cut the rate by 25 bps in September 2025, while 2 more rate cuts have been penciled in by year-end. The AI build-out is now a macro capex theme and is gaining ground. AI spending is set to surge, with outlays on data centers, chips, and networks projected to top about $2.8 trillion by 2029 as big cloud players race to build capacity. Nvidia's weight in MSCI ACWI has crossed entire country weights like Japan and China. The top 10 companies command approximately 35 to 40% of index cap and a record share of earnings. Outside the top 10, profits have been largely flat in recent years, so ex-mega caps the US market looks much less buoyant. INR has been depreciating despite a softer DXY, low inflation, steady CAD, and high FX reserves. The reasons being other than macro, tariff-related pressures and continuous FPI outflows. With RER now going below 100 and touching 98 levels and tariff resolution progressing, INR should also find ground around current levels. Once INR stabilizes, foreign outflow should subside and we may see net inflows also coming into the markets. The pre-tariff front-loading of US imports from India gave way to softer shipments once phased tariffs kicked in from August 2025. The full demand and price pass-through to Indian exporters is likely to unfold in the coming months. Moreover, domestic demand had been slowing down and contributed to the single-digit sales growth of Nifty 500 companies over the last 9 quarters. However, as policy transmission gathers pace with GST rationalization, lagged effect of income tax cuts, RBI easing year-to-date, and ample liquidity filtering through, likely pickup in consumption demand should lead to a recovery. We believe that next 2 to 3 months would be the moments of truth for the market as full impact of the tariffs are felt by the economy amidst domestic consumption stimulation triggered by fiscal reforms. The intensity of earnings downgrades has eased to modest levels. The latest quarterly cuts have been the lowest in the past 4 quarters. We expect pickup in demand to materialize and earnings trajectory to recover. 60% stocks from Nifty Small Cap 250 Index and 45% of Nifty Mid Cap 150 Index are down more than 20% from 52-week highs. We believe that as market picks up momentum, mid and small cap segment may outperform given the extent of correction. The temperature gauge index remains in the fair value zone. Global rate cut delivered by Fed in September 2025 and may gradually ease path but data dependent. Geopolitical conflicts may keep pressure on supply chain and US tariff may impact inflation and growth. However, equities remain resilient and at near highs. INR weakens against major currencies, which is due to its sensitivity to FII flows. However, MCAP contribution of India to global is at 2 years low. Also, DIIs remain strong, cushioning indices. India's price-to-earning ratio is elevated but cooled from prior peaks even as ROE improved, which justifies the premium. The mid and small caps is still rich versus long-term average. GST reform, rate cut, above-average rainfall, rate easing, income tax rationalization, 8th pay commission etc. shows that levers for consumption wave looks good in India and we may see India reaping benefits in coming time. Festive demand already looking firm as autos, SUVs, entry cars, consumer durables and electronics, real estate registrations and petroleum products show strong prints. Equity view, neutral. Portfolio allocation, 60% allocation to large caps and 40%, 5% overweight, allocation to mid and small caps. Investment strategy, lump sum investments in hybrid funds at current levels. For pure equity-oriented strategies, a staggered SIP/STP approach over the next 3 months is prudent given elevated valuations and higher volatility. Any sharp correction should be used for aggressive deployment. RBI kept the policy rate at 5.5% and neutral stance unchanged on back of benign inflation with resilient growth. However, there remains a scope of policy being accommodative on back of lower inflation prints, global headwinds or Fed cementing more policy easing. On the yields front, the curve has become more steepened wherein the yields at longer end of the curve, 10 to 30 year, has inched up on back of H2 borrowing calendar, currency weakening etc. However, yields are expected to remain range-bound in near to medium term. Yields at the shorter end of the curve are relatively benign on back of active and comfortable liquidity management. Hence, current scenario supports the case for maintaining accrual calls across the credit spectrum as the core strategy. Accrual can be played across the credit spectrum by allocating 45% to 55% of the portfolio to performing credit and private credit strategies. Select InvITs, REITs, NCDs for a period of minimum 3 to 5 years. For less than 3 years holding period, one may allocate in relatively liquid fixed income alternative solutions like arbitrage funds, minimum 3 months holding period, income plus arbitrage fund of funds, minimum 2-year holding period, hybrid SIF funds, minimum 2-year holding period, conservative equity savings funds, minimum 3 years holding period. Rising commodities prices have been the highlight of the month, with gold and silver reaching all-time highs on the back of de-dollarization, uncertainties around tariffs leading to rise in safe haven bid for these assets. A very sharp, almost exponential near-term rally in any asset class always should warrant some bit of caution in terms of deployment strategies for investors. We suggest taking more of asset allocation view for any further deployment in these commodities now.